What is the difference between property taxable value and market value? Imagine you're looking at a house and wondering how much it could sell for versus how much you might owe in taxes. These two numbers are related but serve very different purposes. Let's break down what each one really means. Market value is the price a property would fetch if it's sold in an open market today. It reflects what buyers are willing to pay based on recent sales of similar homes nearby, the home's condition, location, and current economic trends. Real estate appraisers usually determine this value. It helps buyers and sellers set fair prices and negotiate deals. Taxable value, however, is used only for calculating property taxes. It starts with the assessed value, which a local government tax assessor assigns after inspecting the property and reviewing recent sales data. The assessor looks at things like the size of the home, the number of bedrooms and bathrooms, any upgrades or repairs, and neighborhood trends. Once the assessed value is set, it is multiplied by a specific percentage called the assessment ratio. This ratio is set by local authorities and usually falls between 80 and 90%. For example, if a home has a market value of $100,000, the assessed value might be $50,000 if the assessment ratio is 50%. Next, the assessed value is multiplied by the local tax rate, called the mill levy, which is expressed in dollars per $1,000 of taxable value. If the mill levy is $9 per $1,000 of taxable value, then the property tax would be calculated on the taxable value. Using our example, the tax would be $50,000 times $9 divided by 1,000, which equals $450. The main difference is that market value shows what a property could sell for, but taxable value determines how much you pay in property taxes. Market value can change a lot with market conditions, but unless the assessed value is updated, your property taxes stay the same. Assessments are usually done every few years, and laws often requiring assessors to stay within a certain percentage of the actual market value. Understanding this difference helps homeowners know why their property taxes might not match the current market value of their home. If you think your assessed value is too high, you can usually appeal it to lower your taxable value and reduce your tax bill. Remember, your property taxes are based on taxable value, not market value, so keeping track of how your assessed value is determined is key to managing your property expenses.